Hello and welcome to This Explainer. As your equity analyst today, I'm going to guide you through a really comprehensive, step-by-step valuation where we literally crack open Balchem Corporation's financials. Our mission here is simple. We want to look past all that daily market noise and figure out this company's true intrinsic value. And we're going to do that using hard data, strict modeling, and absolute clarity. So let's dive right in. To set the stage, we first need to look at where the market currently values the company. Right now, Balchem stock is sitting at exactly $161.52 per share. Now, context is absolutely everything in valuation, and this price point actually represents a drop of roughly 12% from its 52-week high of $183.90. Though, it is still up nicely from its recent lows. That recent 12% drop brings us to the pivotal question for today's analysis. Is Balchem currently historically overpriced, just catching a brief breather before falling further? Or is it secretly hiding a massive 20% margin of safety for the astute investor? To solve this mystery, we're going to act as financial detectives. We'll funnel the raw data through 4 strict valuation models to uncover the ultimate verdict. Here is our roadmap for today. First up, we'll establish the valuation setup. Second, we'll dive into absolute valuation by looking at the cash. Third, we'll check out relative valuation against the market. Fourth, we'll do an asset-based valuation of the books. And finally, we'll synthesize it all into a final intrinsic value. All right, starting with section 1, the valuation setup. Any rigorous valuation requires filling in a few blanks, because the uploaded filings don't give us a specifically stated corporate discount rate or, perfectly matched external peers. We have to establish some sensible default assumptions to make this work. So we're assuming an 8% cost of equity, which is derived from a standard 5.5% market risk premium. We're also capping our long-term terminal growth rate at a very conservative 2.5%, keeping it roughly in line with global GDP. And for our relative valuation, rather than forcing a clunky comparison with mismatched competitors, we'll just use Balchem's own robust 3-year historical averages as our primary comparative baseline. Moving right along to section 2, absolute valuation, focusing on the cash. Our primary tool here is the discounted cash flow or DCF model. The logic is pretty straightforward, but it's incredibly powerful. Step 1, we project the company's future free cash flows to the firm. Step 2, we apply our 8% discount rate to bring all those future dollars back to their present value today. And step 3, we divide that massive sum by the total outstanding shares to pinpoint an exact intrinsic price per share. Now, what's really interesting is what happens when we plug the actual real-world data into that formula. We start with Balchem's trailing 12-month free cash flow, which sits at a really solid $173.06 million. We then project that out using their impressive 5-year historical free cash flow compound annual growth rate, which is 8.20%. When we discount all of that back to the present, the DCF model reveals a powerful, mathematically driven fair value price of exactly $206.98 per share. But hey, a good analyst never relies on just one single model. If we try to shift to a dividend discount or residual income model, we actually hit a bit of a roadblock. The filings just lack the granular and forward guidance needed to map those out precisely. So proxying with an earnings-based absolute model instead, essentially looking at net income and EPS, calculates out much lower at $160.40. And that's despite the remarkable 16 consecutive years of dividend increases. This tells us a really crucial story. Balchem is vastly more efficient at converting its operations into raw cash than its standard accounting earnings might suggest. Okay, let's flip over to section 3, relative valuation, analyzing the market. Let's start with the classic metric, the price-to-earnings ratio. Balchem is currently trading at a trailing PE of 34. Now I know, in a vacuum, 34 might sound like a bit of a premium multiple, but remember our baseline. When measured against itself, this is actually a 13.18% discount compared to its own 3-year average PE of 39.16. Basically, the market is suddenly demanding less of a premium for $1 of Balchem's earnings than it has over the entire last 3 years. And the story is identical when we look at cash. Looking at the price-to-free cash flow ratio, the current multiple sits at 30.15. Again, when we compare this to its historical 3-year norm of 33.30, we see the stock is trading nearly 10% cheaper on a cash basis. We see the exact same pattern emerge when we look at the capital structure neutral metric, enterprise value to EBITDA. The current multiple sits at 20.64. This represents a clear 7.4% discount to its 3-year historical average of 22.29. So, what's the big takeaway here? Well, from a relative valuation perspective, across literally every major multiple we track, whether it's earnings, cash, or enterprise value, the implied intrinsic value suggests the stock is undeniably undervalued. The market is currently pricing Balchem's operations at a 7 to 15% discount to its own established multi-year historical baseline. All right, moving on to Section 4, Asset-Based Valuation. Let's check the books. Asset-based valuation relies on calculating the net asset value, or NAV. Theoretically, you adjust the balance sheet items to fair market values, sum up the assets, subtract the liabilities, and divide by the share count. It represents the absolute floor value. Think of it as what the company would be worth if it halted all operations today, liquidated everything, and just paid off its debts. Now, because the filings don't provide granular mark-to-market values for every individual asset, we have to calculate a raw, unadjusted NAV using the price-to-book ratio. By taking the current share price of $161.52 and dividing it by the current price-to-book ratio of 4.12, we isolate the raw book value per share. That gives us a strict liquidation floor of approximately $39.20 per share. Finally, Section 5, Synthesizing Intrinsic Value. We've built our models, we've gathered our clues, and synthesizing this entire dossier shows a pretty wide spread. But honestly, that is completely normal in financial modeling. We've got a strict asset floor of $39.20. We have an earnings-based fair value of $160.40, which is basically right where the stock is trading today. We've got a very clear signal of relative undervaluation from historical multiples. And finally, we have a robust cash-driven DCF value of $206.98. To find the true price, we have to weigh the strengths and weaknesses of these models. The NAV is definitely our weakest link here, due to a lack of precise fair market adjustments in the public filings. I mean, it ignores the value of Balchem's ongoing operations entirely. The EPS models suggest the stock is fairly priced today, sure, if you only look at accounting profit. But the DCF is absolutely our strongest, most reliable model here. Why? Because it's backed up by actual operational efficiency. Balchem has a high return on invested capital of 11.08%, and far more importantly, they are experiencing a massive 18.27% trailing 12-month growth in free cash flow. Seriously, they are a cash-generating machine. Because Balchem's true engine is that cash generation, we absolutely must weight the discounted cash flow model most heavily in our final synthesis. When we compare that $206.98 DCF value to the current market price of $161.52, it yields a highly attractive margin of safety of nearly 22%. So, as your analyst, here is my final judgment based on the models. Despite the more conservative earnings-based fair value suggesting the stock is fairly priced, the overwhelming strength in actual cash flow conversion, combined with the distinct 7 to 15% discount across historical relative multiples, points to a clear mathematical undervaluation. The deep cash flow math points directly to a $206.98 valuation. The business is fundamentally outperforming its current market price tag. This leaves us with one final provocative question to consider. How long until the broader market wakes up, reads the cash flow statements, and realizes the 20% discount sitting right in front of them? Thank you for joining me for this explainer. Keep your eyes on the data, and as always, keep learning.